JJ the CPA here. Hope you're doing well. So let's talk about buying an SUV or a heavy truck for your business and getting the write-off for that, the tax deduction for that. There's a number of things to look at here. Now, the first thing I want you to note that you probably aren't hearing or reading or being advised, because people either forget or they assume that you know, is that when you look at the tax law in writing off any asset, including a business vehicle, and again, we're focusing in on SUVs and heavy trucks, and I'm going to define that for you in a minute, is that you are only able to write off your business usage. So you can buy a vehicle in a business, but if you're not using it for business, it's not going to yield a tax deduction when you look at actually how the law works. Now, one of the things that's interesting is that that is determined year by year. So when you get close to the end of any year end, right? Well, from the date that you purchase it to the end of that year, you're then looking at, well, what is my percentage of business use? Because to that extent is what then determines how much of it you get to tax deduct. More notably, you get to depreciate. So if you only use an asset 60% for business, then you're only going to be able to take 60% depreciation on that automobile. Now let's back up for a second. When you're now looking at an SUV or a heavy truck, and what are those special rules? Those are defined by over 6,000 pounds GVWR. So it's over, that's to be key, 6,000 pounds, and that's gross vehicle weight rating, GVWR, okay? So the thing is you don't add it up. You don't go, well, is it curb weight plus the payload? No. Every vehicle is going to have that rating, GVWR. It has to be over 6,000 pounds. You don't get to look at anything else related to that vehicle other than the GVWR. So if it's over 6,000 pounds, then the laws I'm getting ready to tell you about apply. If it's 6,000 pounds or less, you don't get to take advantage of what I'm getting ready to tell you about. Now, we talked about the business usage, but the next thing to ensure that you know before you even go the next step is that when you buy a vehicle in the business, then the business actually has to own it, as in actually needs to show on that title. And for you to be able to write off the business expenses, you would always have to have the business pay for it. Well, that's just the same as you would need the business to pay the loan on that vehicle for the business to be able to, first of all, even have a chance of getting the write-off. But the other thing is that loan needs to be in the name of the business. Now, there's a couple of ways that you can approach that. First is it's just strictly titled in the name of the business, and strictly the loan is in the name of the business. But for many, when you go to buy the vehicle, if you have a small business, they're not going to give a loan to your business. You're going to have to sign on it. So it does seem proper, based on my experience, that when you title it, it can be in your name and the business name. And when you get the loan, it can be in your name and the business name. In essence, you'd be a co-signer, you would be a co-owner. Now, you can talk to your own advisors about that. If they have a different opinion, then follow their opinion on that. But the reasoning I'm bringing that up is that any audit that I've been involved with in about the last 10 years, if there's a business vehicle involved, the number one thing that the IRS auditor wants to see is the title to ensure that it's actually a business asset. The second thing they want to see is then the loan document to see that the business is, in essence, on the hook for that loan. And then they will want to see that the business actually made the payments. So again, if you're going to get a business vehicle, remember you only get to write it off to the business usage, that percentage of use for business. It has to be titled, has to be paid in through the business, and the business needs to be on that loan. So if you're not able to accomplish those things, or you're really not going to have very much business usage because you're actually buying a vehicle that your spouse is going to use, but your spouse doesn't have anything to do with the business, therefore the vehicle is really not going to be used for business purpose, then there really wouldn't be a reason to go ahead and buy that vehicle through the business. Now, I know many will look at all of this, they may listen to it and go, well, catch me if you can, right? They'll smirk about it. All I'm trying to tell you is that the law is pretty specific on how to go about this. And we're only able to take tax deductions and depreciate business assets if they've been done properly. And it comes down to the documentation. Now, let's actually get into what is the tax law that allows you to get these sexy, sexy tax deductions. So there are really three ways you can go about writing off the SUV, the heavy truck, over 6,000 pounds GVWR. Well, the first is that you can just depreciate it over 5 years. So there's what's called the maker tables, MACRS, and it's just an acronym for the tables that are used for tax purposes. And it's not strictly 1/5, 1/5, 1/5, 1/5. When you look at makers, it's front loaded in terms of what you're able to write off, and then it's a little less the next year and a little less, and then so on and so forth. So you can depreciate it over the 5 years. The reason I'm not going to give you a number is I don't know what the cost of your vehicle is. So that's the first way. The second way is there is what's called bonus depreciation. And this is a code section that's in play for 21, for 22. It does slightly change in 2023, but the bonus depreciation allows you to get a 100% tax deduction to the extent of the cost of the vehicle. And of course, you have to take into consideration the business usage. So if you bought an SUV or a truck over 6,000 pounds GVWR for $50,000 and you had 100% business usage, then that would be a $50,000 tax deduction. Now, the third way that you can go about it is under Code Section 179. And this for a over 6,000 pound GVWR SUV or truck, that you're able to write off immediately the first $25,000 immediately. And then above that, you would be able to just take the option of having the rest of it depreciated over 5 years. Now, technically, for those that are really knowing about how this works, you can take Section 179 for the first $25,000, and you actually could take bonus depreciation on the amount above that. So you would want to look at Section 179 a little more closely because Section 179 is only allowed to a certain dollar amount. And if you have a ton of new assets, this would be well over $2 million of assets placed in service in the current year, that starts to get phased out. And Section 179 depreciation can only be taken to the extent of net income plus officer wages. Now, right there, you might have had your head spin just a little bit, and that's why you really don't want to act alone on this. You want to talk to your advisor. But here's the thing to know. If you know your business has net income and at least enough net income to cover $25,000, and you haven't bought a lot of assets in the current year, then you really are going to have the option to do any of these. Now, with bonus depreciation, where I told you can just write off 100% of it, the one thing I want you to note on that is that it can be taken beyond the net income, meaning it can create a loss. Now, you'd want to make sure you have basis to take the loss. So you understand that now it may sound like I'm getting in the weeds. Well, I'm not really getting in the weeds other than to say this is an issue you want to look at carefully before you go and do this. Ensure that you have a complete kind of grasp of how it impacts your tax return, how it impacts the ability to actually get the write-off. So if you, in essence, document it properly, pay for it through the business, title it properly, the business is on the loan with you or on the loan, and you have whatever business percentage usage, and you're using it for business on an ongoing basis, then you're able to write it off. Now, a couple of things I'll usually have with over 28 years of experience, follow-up questions from clients is, well, can I just buy it this year, use it for business, and then not use it next year? Well, the short answer is sure, but there would be some tax ramifications from doing that. So I'm not going to go through what those are. You just need to know that, well, you can, but you're going to either recapture the depreciation or you'll have to take a distribution for the asset. But there'll be some other counter to it. There's not going to be an opportunity for you just to get the deduction and then turn it into a personal asset with no further ramification. The other thing I do want you to note is that when you sell this SUV or this truck or you trade it in under current law, that will be a taxable event, right? That's always been the case in terms of when you get rid of the vehicle. Now, it used to be when you traded in a vehicle under Code Section 1031, if you were trading in a business vehicle for another business vehicle, well, there would potentially be a gain, but you could defer the gain by reducing down the basis of the next vehicle. All you need to know is this: that law doesn't exist anymore. So whether you sell or trade your vehicle, that is the taxable event. And if you sell it, obviously you know the sales price. If you trade it, then, well, whatever your trade value is, well, then that's going to be in essence your sales price. And you're going to then compare it to what is your tax basis. So it's not, well, what did I pay for the vehicle versus what I sold for the vehicle, only when you're talking about for taxes. What you have to look at is, well, what did I pay for this vehicle? How much depreciation did I take? Because that is going to reduce down that tax basis to then determine what's my taxable gain. An example would be you buy that vehicle for $50,000. You write off in the first year the full $50,000 under bonus depreciation. Well, you bought it for $50, you took depreciation of $50, well, then your tax basis is zero. Therefore, whatever you sell it for, it's going to be a gain from that perspective. Now, this is just how it works, whether you're buying machinery or computer equipment or the like. You take your basis for tax purposes, cost minus depreciation, to then determine what is going to be your taxable gain. And depending on the depreciation that you took, determines then your tax rate. Typically, it's going to be an ordinary tax rate, not capital gains, because a vehicle is not a capital asset. Why am I telling you that? Because whether you trade or sell, if you're able to, and if this makes sense and good economic sense, right? You can't just look at it from tax reasons alone. But when you're looking to get rid of a vehicle for businesses and you know you're getting the next one, whether it's for, sorry, my battery went down. I lost my train of thought there. But if you know you're getting rid of this vehicle and you know you're getting your next vehicle, both of them in the business, then by getting them in the same year, you're able to offset that tax effect. What does that mean? Well, you buy it for $50, you wrote off $50, your tax basis is zero, you trade it in or sell it for $20,000. You have a $20,000 taxable gain, and it's going to be taxed at ordinary rates. That just means regular rates, not capital gain. But if you bought another $50,000 vehicle, then you're going to be able to, assuming 100% business use, and you structured it all the right ways, you would be able to write off the $50,000. But net, you would really only be realizing a $30,000 overall tax benefit, right? $20,000 gain, right? But then a $50,000 tax deduction, which is an ordinary tax deduction, will net those two things together, and then you're looking at a $30,000 tax deduction net. So don't hear me wrong. It's a $50,000 tax deduction. It's a $20,000 gain. You will recognize both as separate transactions, separate line items on your tax return. However, it will net to a $30,000 tax deduction. Now, if you're trading in the vehicle, well, you got $20,000 in value towards a $50,000 vehicle, so the net out of your pocket is $30,000. Or another way to look at it is just the same math that I told you. So you want to be aware of the full ramifications of this so that when you go in and you decide to get a vehicle for your business, and it's the sexy deduction with the over 6,000 pounds GVWR, that you really see that it does really require that it walk and talk the way that it should. So the last thing I'll say is that when you're looking at this, fellow small business owner, self-employed, is how would you know if it was business or not? That's how the IRS is going to need to know, right? The business paid for it, the title. So when you're looking at, should you do this, the first is what I told you in the beginning. Well, what's going to be your business usage? What's your continued business usage? And does it even make sense to do it? Because are you going to have enough business usage for that to happen? Now, I did say that I was going to tell you that in closing, but I do want to let you know that you would want to talk with your insurance company, your auto insurance company, and ensure that they understand how it is being titled, whether it's all in the business or your name is on that title with the business. And the reasoning for that is that you don't want to have an accident and your insurance company not be aware of the ownership, because that does change liability, and somehow your claim is not valid or isn't accepted because they weren't aware of the full title. So you may need to get a rider for commercial liability on the vehicle, or you may have to get whatever your state law is going to require, whatever your insurance advisor is going to require. So when you look at what the IRS would audit, if for whatever reason you were selected for audit and they then are looking at your return, this would be something they'd want to inquire of. However, if you follow all the things that I indicated, then you don't have any issues related to that. So when you're driving that vehicle, even though it's in the business, you would want to track your mileage. That is the easiest way to know, well, what is your business usage versus your personal. All right, hey, I tried to give you as much as I could there. Again, you want to act by consulting your advisors, and you want to act in a way that if you are audited, that it withstands it and you get that tax deduction. All right, I think I covered it all the things that I talk to my clients about. Hopefully that is helpful. All right, hey, thanks for tuning in. I'd love it if you subscribe. And then don't you ever forget, you've never met a CPA quite like me. Have a great one.